I want to welcome you to our seminar on smart beta. You see a term like smart beta, obviously that looks much more intelligent than a term like dumb beta. And as we will see as we go through here, there is something smart about this particular approach compared to some alternative approaches. I think first, before we jump into smart beta, we really need to have some background on some different investment approaches, some traditional approaches, so we can draw a contrast. So on this slide, you'll see traditionally you've had active investing or index investing. Active investing is involved in picking individual stocks or using mutual funds that have active managers of the funds, as contrasted with index investing, which is simply tracking an index. Active investing, you can think of it as having two parts: a qualitative part where you read financial statements, you might meet with company management, you do some analysis; a quantitative part, which is much more rules and ratios and things of that nature. The question with active investing is, does it, quote, generate alpha, alpha being the extra return beyond just the market return. Index investing, which is in funds that track things like the S&P 500 index or the Dow Jones index, is based on the capital asset pricing model. We're going to do just a short look at what that model represents and what it means, because again, we have to appreciate what that model is saying as we look into smart beta. But in that model, it links returns that you might expect from an investment with the risk of the investment, which is intuitively does make sense. If you want to get higher returns, you normally do take some extra risk. Or if you want some lower risk, you normally do expect some lower returns. With index investing, the term beta is equated with market volatility. So the entire stock market, for example, would have a beta of 1. If you're in a particular fund or stock with a beta of 1.2, you're about 20% more volatile than the general market. A beta of 0.8 would be about 20% less volatile than a general market. Now, as we move into smart beta, I want to first recognize that this is a term. That's all it is. And the investment industry many times repackages things with different names. And smart beta itself has many different names. We'll primarily use the term smart beta, but strategic beta, alternative beta, and you'll see some others on this slide, are all different names that by and large still all refer to the same concept. Now on this slide, you'll see a big circle in the middle with smart beta, to the left active and to the right passive. So what this illustrates is that smart beta really does sit between a very active strategy and a somewhat passive strategy. And we'll take a little deeper dive into this in another slide. In this next slide, what this looks at is that on the far left-hand side, you see market capitalization weighted indexing. So this is your traditional fund, let's say, that tracks the S&P 500 index. On the far right-hand side, you see active investing, whether it's done through individual stocks or done through active funds. And you have a dispersion, either on the positive side or the negative side, because it is active. So it could be making good decisions and doing much better than a market cap weighted index, or worse. So in between the left-hand side of market cap weighting and the right-hand side of active investing, we see where strategic beta fits. So it's along this continuum, and it comprises both what we call multi-factor investing as well as single-factor investing, and we'll look a little deeper in a moment at what these terms mean. Now, smart beta, there are many, many products available, and it's growing all the time from investment companies of smart beta ETFs. So on this slide, you simply see some of the major providers like iShares and Vanguard, the number of ETFs or exchange traded funds that they have that are addressing some aspect of smart beta, and then actually how much money are in these funds. So, but it's a number that's constantly growing. So as you can tell, there are hundreds of different ETFs that track some form of smart beta. Now, on this next slide, we're looking at some of the problems that smart beta addresses. Why did it ever come about to begin with? And usually it's trying to solve some issue or problem or challenge. So the issue with active investing is it's more expensive, and the question is the performance good relative to the cost? And in some cases it is, and in some cases it's not. Index investing, on the other hand, has its own challenges. One is the construction of the index. We'll look deeper at that on the next slide. The second is that CAPM, the capital asset pricing model, the theory behind the markets and the reason really indexes were developed, has what we call some anomalies or question marks. And again, we'll take a little deeper look at this. So smart beta, again, sits between active and indexing, trying to address some of the challenges or problems with both the other strategies. Now, the next slide looks at the typical index fund construction. This particular one is looking at the S&P 500 index. And that index is comprised of 500 companies, but that does not mean that they count equally. It is not an equal weighted index where each company is 1/500th of the total pie. On the other hand, is what we call a market capitalization weighted index. So the bigger companies like Apple or Exxon or Johnson & Johnson, these bigger companies take up a larger slice of the index and therefore any funds that track the index than smaller companies. Apple itself is over 3% of the index. So what this looks at, if you took just the top 10 stocks out of 500, that's 20% of the entire index. The top 25 is over a third of the total index. Or jumping to the bottom, the top 100 is roughly 2/3 of the whole index. So the remaining 400 stocks just make up the final third. So it's a top-heavy sort of index, which also means, since it's market cap weighted, it is what we call a price momentum index. You own more and more of what's going up. You own less and less of what's going down. Let's think about this from the standpoint of the manager of an index fund tracking the S&P. If Apple Computer goes up in value as a percentage, with a greater percentage relative to the other stocks in that index, you have to buy more Apple because its market cap has just increased to maintain the same ratio in the index. So because it's going up relative to the other stocks, you buy more and more of it. So it is a price momentum index, obviously not very value oriented. So we looked at one problem with indexing in the sense of the construction of the index and market cap weighting. The second challenge with indexing is that there are also problems related with the capital asset pricing model itself. Now, it's an excellent model developed back in the 1950s that simply equates risk and reward, which is logical that higher reward investments probably contain higher risk, but it doesn't go far enough. That doesn't explain everything. So over the years, in academics, as they researched this, they came up with a number of what they referred to as anomalies, things that are not quite explained under the capital asset pricing model, things that work, but the model would suggest they shouldn't work. It's sort of like the bumblebee who's not supposed to be able to fly, yet he flies. What are some of these anomalies? Value being one, that value stocks over long periods tend to outperform more growth-oriented stocks. Small stocks, even after adjusting for the fact that they are inherently riskier, they still had outperformance compared with larger companies over long periods of time. Similarly, you look down for liquidity. Less liquid actually outperformed more liquid. Momentum, that stocks with the wind at their back continued in general outperforming their slower brethren. Higher quality tended to outperform low quality. Low volatility tended to outperform the higher volatile stocks. And stocks with dividend yields tended to outperform those that did not pay dividends. Again, these were anomalies that could not be adequately explained under the capital asset pricing model. We now refer to all of these as factors, which is one of the foundations in smart beta. Now, taking these factors into account on this next slide, this looks at the annualized excess return of each of these individual factors versus the general market. So you see the quality factor has outperformed on a annualized basis about 1.3% a year, just as an isolated factor compared to the general market. And these other factors of volatility, momentum, value, liquidity, and finally size being small companies, have added 4.5% per year in additional return compared to the general marketplace. Now, as you might suspect, on the other hand, there's no free lunch. That's over long periods of time. What about shorter periods of time? Well, this next slide is where we sober up a bit. And we see that all of these factors have had very long periods of underperformance. So even the factors like size that had the greatest outperformance may go through, and this only takes us out for 60 months, 5 years, but there have been periods of over 5 years of drastic underperformance by these factors. Now that actually is good news in the sense that the reason these factors are persistent, the reason they hang around, and even though the secret, if you will, has been discovered, is because not too many investors are patient enough and willing to go through a number of years of being out in the wilderness, out of fashion, trailing the broad indexes, even though long term it might be a payoff. It's very tough to maintain focus on certain factors through several years of underperformance. Now, the next slide simply gets some terms out there. So on the left-hand side, you see beta and you see alpha. Beta being the performance, again, of the overall market. Alpha being the skill of the individual manager, either in picking stocks or allocation of funds. And that's what is called a simple alpha interpretation. Now, on the right-hand side, it takes that same concept, except it breaks the alpha into two parts. One is the skill of the manager, which is still there, but the other is factor betas. In other words, partly it's the manager's skill in choosing a particular stock to invest in, partly it's the degree that that stock is embracing one or more of these factors of value or size or quality to explain how that alpha got generated. So, as I said, smart beta sits between active investing and traditional index investing. So now let's just look at how it differs. One, it is quantitative. It is systematic and rules-based. So it comes up with a construction technique for the particular area that it's investing in, be it small companies or quality companies or dividend-paying companies. It has rules-based. It has a custom index. So instead of saying, oh, we're tracking the S&P 500 index, each smart beta fund actually develops an index based on its rules and then simply follows the index that it created itself. So these are custom indexes designed just for investing. It also focuses on factors. It could be a single factor like value. It could be multiple factors at the same time. And finally, weighting. It tries to break the link between price and portfolio weight. So again, take the S&P 500 again. The traditional fund there has not broken that link. The weighting in the portfolio is very much based on the market cap. With smart beta, the weighting should differ in some way. Now, I say maybe here in parentheses because some funds that market themselves as smart beta have not actually broken that link or haven't broken it as well as other funds. And we'll discuss this in a little more detail in a moment. So again, just another look at where we position smart beta. Passive is low cost, cheap, very transparent. It does have sometimes excessive risk concentrations, as we saw in the concentration of the S&P. It has an embedded bias towards large companies or large cap because of its market cap weighting. On the right-hand side, you have active, so they're actively managing risk, is the potential for outperformance or underperformance. It's higher cost. But in the middle is strategic beta. It's lower cost than active, but higher cost as compared to passive. But it does combine active management in a rules-based environment. So it really is an actively managed product in our definition, following very systematic rules. Now, this next slide will look at some types of smart beta strategies. And what I want you to focus on, in the top sort of grayed out area, the first one says alternatively weighted. And then below that it says single factor. Now, to really be a smart beta strategy, you normally have to combine both of these. So some funds would market themselves as smart beta, but really just be focusing on a factor, but not doing any alternative weighting. To us, those are factor funds, certainly, but they're not really smart beta funds. The analogy to think about is that a Rolex is a watch, and all Rolexes are watches, but not all watches are Rolexes. So all funds that, let's say, focus on factors are not smart beta funds, but all smart beta funds do have some focus on factors. So under alternatively weighted, let's move on to the next slide. And we'll look at different ways that a fund could weight the stocks in its portfolio that would be different than traditional market cap weighting, where the biggest ones get the heaviest weight. Some funds are doing it by revenue. So they simply look at the gross revenue companies generate, and based on that revenue, that's their weighting. Some do it on earnings. Think of earnings as your net, the profit that companies would have, and weight it by profits. Some do it by dividends, the dividend paid out by companies. Sometimes it's equal weighted. It may take, say, the S&P 500, and each stock does count 1/500th in the portfolio. And finally, there's another way of doing it based on fundamentals. And we're going to take a little deeper dive on fundamentals on the next couple of slides. So fundamental indexing is one of the methods of alternatively weighting a portfolio. And the one index that we're going to look at specifically as an example, there are other ways to do this, is one created back in 2005 called the Fundamental Index, with a goal being to break the link between the price of a stock, the market cap or capitalization, and the weight in a portfolio. Rob Arnott, who developed this method, referred to it as a company's economic footprint, how significant a company is in the economy versus its market capitalization. So on the next slide, we see the approach on the fundamental index. If you're not doing it by market cap, what are you doing it by? Well, this one weights companies by 4 different measures. Sales, so gross revenue, cash flow, which would be net cash flow, dividends, and book value. And it takes a average of these different approaches. Now, that's the alternative weighting, different ways to do that. Now let me kind of shift back a bit on the various factors that we looked at and just talk about how smart beta funds use these factors to invest sometime tactically. So let's take, for example, the small size factor. The types of companies, obviously smaller companies. The most favorable environment for that is early in economic cycles. Doesn't mean it can't function well later in cycles, but that tends to be the most favorable time to focus on that particular factor. And then you see for the other factors here, kind of a description of the factor, but also a time in the cycle when that factor tends to find most favorable. So we've looked at alternatively weighted strategies from dividend weighted to fundamental weighted. We've touched on these different single factors of momentum or size or quality or value. And there's certainly many exchange-traded funds that track these individual factors, hundreds of funds. Now I want to move into what we call a multi-factor conversation. So instead of looking at just these factors individually in isolation, a multi-factor strategy and funds that are what we call multi-factor funds actually invest in, as you might imagine, multiple factors, not just one. Let's look at a rationale for this on this next slide. So one reason for the advent of these multi-factor funds, I'd mentioned earlier that factors can have very long periods of underperformance. So multi-factor funds are a little more nimble to potentially shift their weights somewhat between one factor and another. Now you can see on this chart of factor returns by year a reason for that. In the boxes that have the white background is multi-factors, which tend to be on this chart always in the top 1/3 of the chart, as opposed to never being on the bottom of the chart, because sometimes certain factors may be on the bottom of the chart for several years and just occasionally rise up to the top. So the objective of a multi-factor fund is simply to, one, get exposure to multiple factors, but also to lean the fund left or right to emphasize or de-emphasize certain factors sometimes. Now, on this slide, which is our final slide of the presentation, we look at an example of one particular multi-factor fund. Again, there are many of these out there. We're just looking at an example, but this one does a good example, I think. And it takes these different factors of value, quality, low volatility, momentum, and size. It divides the fund among these factors. And then within each one, let's just take the value factor, it would first select the top 25% of stocks in their that are value stocks by this value factor, and do a similar thing in quality or low volatility. But then it can also adjust this somewhat based on some market conditions. So it's not just a static allocation, but it will, again, slightly vary over time to try to avoid long periods of underperformance by a single factor. So at a time a certain factor is just sort of out of favor, it will still have some exposure to the factor. It just won't have as much exposure to that factor. Now, just to summarize, in portfolios, if you're primarily individual stocks, well, you're doing factors whether you realize it or not, because in selecting the stocks, you're selecting more value-oriented stocks or more dividend-paying stocks or smaller companies. So you're getting direct exposure to factors already. If you have an active mutual fund, you do that in a similar way, because you may pick a fund that invests in small companies or more value-oriented large companies, although they're not deliberately trying to target a factor. On the other hand, these smart beta funds is simply a more precise way of either taking an existing portfolio and trying to put some extra emphasis on a factor that you feel like will give you some superior return, so it's more return-oriented, or in some cases looking at an existing portfolio that may have some holes in it and using a certain factor from a risk standpoint to try to lower the risk of the portfolio by giving an exposure to a factor that it doesn't currently have much exposure to. I want to thank you for listening in. If you have some questions, I would appreciate hearing them, and have a great day.